Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone.
The real truth behind the Fed's announcement and how it affects you. As investors anticipate the Federal Reserve's next move on interest rates, the Fed's preferred inflation gauge has aligned with expectations. The Federal Reserve is concluding its latest meeting today, and all eyes are on its upcoming decision regarding interest rates. The Fed has hinted at a major announcement, leaving many to speculate about whether it will lower, raise, or maintain interest rates in its ongoing battle against inflation. Recent signals from the Fed suggest they are considering reducing interest rates, a move that would make borrowing money easier. But why is this on the table, and what implications does it hold for the broader economy? The concept of sticky inflation, a persistent and troublesome form of inflation, is at the heart of the Fed's deliberations. Initially perceived as a temporary issue, inflation has proven to be more enduring, complicating the Fed's efforts to manage it. Market expectations are now factoring in potential rate cuts by June, with a possibility of another reduction in November. This scenario could make mortgages more affordable, benefiting those in the market for a new home. However, a lower interest rate environment might diminish the attractiveness of the US dollar, prompting investors to seek better returns in commodities or real estate. For those considering real estate transactions, this could be an opportune moment to act, as lower interest rates could spur increased activity, especially in the fall. The Federal Reserve's focus on inflation is crucial, given the risk of stagflation, a condition characterized by high inflation and high unemployment reminiscent of the 1970s. The Fed faces a delicate balancing act. Maintaining high rates could plunge the economy into recession, while cutting rates could exacerbate inflation. The political landscape adds another layer of complexity, with the upcoming elections and the Biden administration's low approval ratings potentially influencing the timing and nature of the Fed's decisions. The Fed's admissions and projections carry significant weight. As a key institution shaping U.S. monetary policy, the Fed's statements on inflation, employment, and GDP growth are closely scrutinized. Any acknowledgement of difficulties in achieving these targets could indicate forthcoming policy adjustments. Moreover, the Fed's handling of interest rates amidst economic uncertainties has far-reaching implications for businesses, investors, and consumers. Addressing inflation involves more than just acknowledging rising prices. It also means understanding the broader economic impacts. Inflation reduces the purchasing power of money, leading to higher costs for goods and services. This scenario forces consumers to spend more on the same items, stretching their budgets and potentially curbing other expenditures. The Federal Reserve's primary role includes keeping inflation under control by adjusting interest rates. Lower interest rates encourage borrowing and spending, stimulating economic activity. However, increased spending can also drive prices up, contributing to inflation. Conversely, higher interest rates make borrowing more expensive, which can dampen spending and help control inflation. Currently, the Fed is grappling with sticky inflation, a situation where prices continue to rise despite higher borrowing costs. Various factors, including persistent supply chain issues and geopolitical tensions like the war in Ukraine, contribute to this phenomenon. To combat it, the Fed is considering lowering interest rates again, a decision that carries mixed potential outcomes. Lower interest rates could stimulate the economy by encouraging borrowing and investment, potentially creating jobs and boosting economic growth. However, this approach also risks further inflation. An increase in money chasing the same goods and services can drive prices up, devaluing savings and outpacing wage growth, which could destabilize the economy. For individuals, preparing for potential economic shifts involves careful financial planning. Monitoring budgets closely, building emergency funds, and considering inflation-protected investments are prudent steps. Treasury inflation-protected securities, TIPS, for instance, adjust for inflation, safeguarding the value of savings. The Fed's challenge in balancing inflation control and economic growth is complex, with significant ramifications. Its decisions will impact various economic aspects, from retirement savings to home purchases and everyday expenses. The interconnectedness of the economy means changes in one area can ripple through multiple sectors, influencing livelihoods and financial security. For investors, diversification and adaptability are key strategies. Keeping a well-balanced portfolio that includes stocks, bonds, real estate, and commodities can help mitigate market volatility. Businesses should remain agile, employing scenario planning, cost optimization, and innovation to navigate economic uncertainties and capitalize on emerging opportunities. On a personal finance level, enhancing financial literacy and resilience is crucial. Building emergency funds, managing debt effectively, and investing in skills development can strengthen financial stability and preparedness for potential downturns. Despite the uncertainties, proactive financial management can provide a measure of control and security. The Fed's recognition of persistent inflation underscores the challenges facing the economy. This acknowledgement highlights the significant influence of policy decisions on economic conditions and individual financial well-being. Staying informed and engaged with these developments is essential, as the Fed's actions in the coming months will have widespread implications. While the future is uncertain, preparation and determination can help individuals and businesses navigate economic challenges. By staying vigilant and making informed financial decisions, we can better position ourselves to weather the economic fluctuations and capitalize on opportunities as they arise. The Federal Reserve's decisions will shape the economic landscape, and understanding their potential impact is crucial for making strategic financial choices.